Hello everyone! The past 1 week has been characterized by something that has happened back in early 2021. A revolution by retail investors sticking it to the big boys through a short squeeze play. There wasn't a fairy tale ending back then with many of the short squeeze stocks collapsing in prices following their meteoric rise all within a short period of time. It was just like watching a Fast and Furious movie. Plenty of action to keep you at the edge of your seat. Now, Short Squeeze 2.0 seems to be in play, with free popcorns being dished out by AMC, which is the company now in focus, and ironically, also a cinema operator, as we watch the dramatic climax which has yet to unfold. So, the main lead has changed from GameStop back in early 2021 to the current company in vogue, AMC. Typically, what happens in a short squeeze can be summarized as such. A company has poor fundamentals, which attracts hedge funds to bet that the share price will collapse. They do so by borrowing shares which they do not own to sell short. In the meantime, the hedge funds incur borrowing costs, which is what incentivizes shareholders of the company in question to lend their shares out in the very first place. The hedge funds profit if the company's prices decline, translating to a scenario where they sell high and buy back low. However, if the price of the company which they sold short starts to increase, they might wish to cover their short positions to limit their losses as panic buying sets in. This is short covering in play, and when many funds are doing it all at the same time because prices keeps rising, we have a short squeeze scenario, one where the frenzy buying in of short positions result in even spiraling prices. Now, over the weekend, there's been some interesting developments for AMC. There was a big hoo-ha made with regard to a CNBC reporter unwittingly highlighting that there is naked short selling happening.
A lot of short sellers out there that have been borrowing stock they didn't have. In other words, yes, I think there are dynamics where retail can get caught, but it's really a dynamic where I think this is going after bad companies.
Apparently, YouTubers are catching onto a phrase, naked shorts, yeah? And assuming that she's kind of affirming that naked short selling is rampant for meme stocks. I mean, it could just be an innocent phrase on a part, but when it is music to the apes' ears, they are going to blow it out of context. At this juncture, allow me to explain what is naked short selling and how it is different from the standard short selling process. Naked short selling happens when instead of borrowing actual shares to short when you're bearish on the counter, there's no actual borrowing in this case, or there's no real intent to physically borrow shares. Why is that the case? Most likely because there are no more lenders out there to lend you the stocks, and this is usually the case for shares which are already highly shorted. In this scenario, what happens if you are big hedge funds who still wishes to go short on a stock? Maybe purely because you hate apes. This is when your brokerage firm, who is typically also a market maker, will help you to short a stock without actually borrowing the physical shares. All they have to do is to locate the shares. This is typically only privy to huge institutions where trades are often executed through the unregulated dark pool. When naked short selling happens, it is like creating phantom shares out of thin air. That allows an institution to continuously bet against a company, thus resulting in its downfall. Sometimes, these short positions are also being disguised as long positions by the market makers, thus allowing them to fly under the radar. Now, YouTubers are claiming that there's a huge amount of naked short selling being executed on these meme stocks, particularly with CNBC now confirming that fact. To be honest, even if naked short selling is in play, which we all suspect it could be the case as illegal as that might sound, how can one really prove that it exists beyond depending on the slip-up made by a news anchor? More importantly, will that situation be made to reverse, or is it going to remain status quo? Now, there are two recent developments that are of interest to me. First, some brokerages are starting to limit short selling activities done by hedge funds on meme stocks such as AMC and GME, etc. This is seen as a big deal as brokerages earn a hell lot of money by providing borrowing facilities to institutions for them to sell short. By restricting short selling activities on some of these stocks, it means cutting into their profitability. Are they getting concerned over the possible blow-up of phantom shares? It will be exciting when more brokerages join in the fray of banning short selling. That will really give the apes more reason to go gaga. Second, an interesting development is happening on the 9th of June. This is when GameStop, the dethroned meme king, will be holding its shareholders meeting, and during that meeting, GameStop will count its float by requiring that shareholders provide proof of ownership through legal proxy and valid identification. If it is found that there are more shares being sold than are issued and outstanding, institutions could be held liable for these phantom shares that are sold short. Now, the retail community believes this would be a bullish catalyst for GameStop and for the other meme stocks in play, particularly AMC. Hence, the coming days would be pretty interesting for meme stocks and action could very well continue. Personally, I would think that a gamma squeeze relating to the option market might be the underlying reason behind meme stocks rallying like what it has been over the past week. But that will be another video for another day. We have come to the end of today's financial tidbits. If you enjoyed the video, do remember to hit the like button and subscribe to the NWF YouTube channel where I will also look to provide more follow-ups on the meme stocks topic. With that, this is Royston signing out.